Welcome to the Deep Dive. We're here to cut through the noise and get you the financial insights that, well, really matter. Today, we're taking a close look at the global markets. What's going on? Specifically, we're looking at these big equity rallies, but also digging into the risks underneath, and how expectations are changing. Yeah, our mission here is simple. Unpack the latest market brief, pull out the key takeaways, and help you understand what's really driving the numbers, why it's relevant for you, and, frankly, what you need to keep an eye on. Think of this as your shortcut to being properly informed without drowning in data.
And the source we're digging into today is a weekly market brief, the snapshot as of September 8th, 2025. It really covers the waterfront equity performance, inflation forecast, what's coming up on the economic calendar, all the key pieces. It's pretty dense stuff, but incredibly useful for understanding the current picture and what might be next.
Okay, let's jump straight in then. The brief's thought of the week really grabs you. Equities have pushed their rally further. The S&P 500, it says, is now up almost 10% for the year. That's pretty strong momentum. So what's behind this? What's actually fueling this positivity, according to the brief?
Well, the brief highlights really three main things. First, less worry about trade policy uncertainty. That seems to be fading, which helps businesses plan. Then you've got surprisingly resilient growth in some key economies. And third, another pretty solid earnings season. Companies generally beating expectations. That always helps investor sentiment.
Okay, sounds good on the surface. But like you said, the brief pivots pretty quickly, doesn't it? It introduces some caution despite the rally. What are those signs?
Exactly. That's what's interesting. It points to limited tariff pass-through. So companies aren't fully passing on higher import costs.
Which could mean pressure on their profits. Or maybe consumers aren't willing to pay more.
Precisely. It hints at maybe some pressure on margins or perhaps, softening consumer demand. And that ties into the other point. Growing evidence the labor market is softening, fewer job openings maybe, or wage growth slowing down. So all this together has kind of shifted the market's focus. It's less about the rally itself and more towards recession risks. It's a subtle but important change in focus.
Okay, that's a critical shift. And this is where it gets really fascinating, I think. The brief says the market isn't just noticing these risks. It's actively pricing in what it expects to happen next. It states markets are now pricing in over 100 basis points of Fed cuts in the next year. Wow. What does that actually signify? That level of rate cut expectation.
Yeah, 100 basis points, a full percentage point. That's quite significant. It means the market really believes the Federal Reserve is going to have to cut interest rates pretty aggressively. Not just to, nudge the economy along, but maybe to fight off a more serious slowdown. Or even, yes, a recession. It's a strong signal. Investors are betting on the Fed turning dovish, and they're building that bet into prices right now. It reflects a certain view of the future economy and how the Fed will react.
Right. So this heavy expectation for Fed cuts, the brief then connects this directly to a key vulnerability. It says, and I'm quoting here, current equity market valuations are being supported by a rather benign view of inflation risk. What does benign view mean here, and why is that a weak spot?
That's a great question. It really gets to the core of the market's potential fragility right now. A benign view basically means the market assumes inflation will stay pretty tame, manageable, not a big threat. The consensus forecasts mentioned in the brief see U.S. headline CPI, that's the main inflation measure, rising only modestly, maybe to around 3% from the current 2.7%. The problem, and this is the warning in the brief, is that this forecast leaves little margin for error. The specific risk is clear. If inflation turns out stronger or lasts longer than this modest uptick predicts, well, that would almost certainly mean fewer Fed cuts than the market is currently banking on.
I see. So the whole thing rests on inflation behaving itself, basically. What happens then if inflation does surprise on the upside? If we don't get those 100 basis points of cuts, what are the knock-on effects the brief warns about?
Well, if inflation is stickier and the Fed can't cut as much, the effects would ripple outwards. Fewer Fed cuts would likely push bond yields higher. Remember, bond prices and yields move opposite ways. Investors would demand more return. And higher bond yields could then seriously challenge current equity valuations.
Because those valuations partly depend on low rates making future profits look better today.
Exactly. That valuation argument gets weaker if rates don't fall as expected. So the core message from the brief is pretty stark. The market might be underestimating these upside inflation risks. And if those risks show up in the data, that positive outlook built on rate cuts could, unravel pretty quickly.
That really paints a picture of a market on a bit of a knife edge. Okay, let's shift gears slightly. We've talked about the big picture forces. What about the actual numbers? The market stats as of September 5th. What do they show us? Does the data confirm this broad strength, or are there more nuances when you dig in?
Oh, absolutely nuances. The overall numbers are strong, no doubt. S&P 500 up 11.2% year to date, 19.4% over the year. The MSCI All Country World Index is similar, up 12.4% YTD and 19.1% year ago. Solid. But when you look at the sectors, it's a very different story depending on where you look. It's definitely not uniform. Communications services, for instance, has had a phenomenal run, up 25.5% year to date. And get this, 42.4% over the last year, just huge. Tech is also doing very well, up 13% year to date. Clearly, investors are still very focused on growth, innovation, that sort of thing.
Wow, 42% for comm services. Okay, so who's lagging then? Which sectors are getting left behind in this rally?
Well, healthcare is a noticeable laggard, only up 1.8% so far this year, and it's actually down 8.4% compared to a year ago.
Down 8.4%. That's a massive difference from comm services.
It really is. It tells you where the money's flowing, very much towards growth and maybe away from more defensive areas right now. Reflects a certain risk appetite, perhaps.
Interesting. And beyond stocks, what about commodities and bonds? Anything standing out there, the Breeze data? Does it fit the narrative we've been discussing?
Definitely some key movers. In commodities, gold has just been on a tear, a massive rally, up 36.5% year to date, and an incredible 43% over the last year. It's priced at $585 an ounce.
36% for gold. Wow. What does that usually signal? Flight to safety, inflation hedge.
It can be both, really. Either worries about global uncertainty making people seek safety, or, yes, a hedge against inflation concerns. Or maybe a bit of both. Meanwhile, Brent crude oil is actually down 10.3% year to date. That could suggest worries about softer global demand, maybe linked to those recession risks we talked about.
And bonds. You mentioned yield supporting the rate cut idea.
Exactly. The U.S. 10-year Treasury yield is sitting at 4.09%. Importantly, that's down 48 basis points since the start of the year. That fall in yields is the bond market basically agreeing with the stock market's expectation of Fed cuts. It's pricing in lower rates ahead.
Got it. And just quickly, the VIX, the fear gauge and valuations, what are they at?
Yeah. Right. The VIX is pretty calm, actually, holding around 15. That's lower than the start of the year when it was 17, and definitely lower than a year ago at 20. So, despite the underlying risks we're discussing, market volatility itself seems relatively subdued, maybe even a bit complacent.
Perhaps. And valuations,
Yeah.
PE ratios.
The S&P 500's forward price earnings ratio is at 22.5. The MSCI World is at 20.3. These aren't insignificant numbers. They tie right back to that earlier point. Are these valuations sustainable, especially if that benign view on inflation gets challenged and rates don't fall as much as hoped? They look a bit stretched if the rate outlook changes.
Okay, so that's the current state of play. Let's look ahead. The brief includes a week ahead section. What are the key economic data points or events coming up that we and our listeners should really be watching? What could move the needle based on everything we've just discussed?
Yeah, the coming week has some potentially market-moving releases. On Tuesday, we get the U.S. NFIB index. That's small business optimism for August. The last reading was 100.3, so we'll see if sentiment is holding up there. Small businesses are often a good barometer. Wednesday is China's headline CPI inflation for August. The previous reading was 0% year over year. Any change there will be watched closely for global inflation signals.
Okay, and Thursday looks like the big one, particularly for our inflation theme.
Absolutely. Thursday is packed. First, there's the European Central Bank's rate decision for September. The prior rate was 2.00%. But critically, for everything we've discussed, we get the U.S. inflation data for August. Both headline CPI, the prior, was 2.7% year over year, and the core CPI, which excludes food and energy, it was previously 3.1%.
So this is the real test of that benign view.
Precisely. These numbers will directly challenge or confirm the market's current inflation assumption. If they come in hotter than expected, well, that could really shake those Fed cut expectations and trigger a market reaction. Then on Friday, we round out the week with UK GDP and industrial production for July, plus the first look at U.S. consumer sentiment for September from the University of Michigan. The prior was 58.2. So yeah, a busy week for data watchers.
Okay, so pulling this all together after our deep dive, what's the core message, the essential takeaway for someone trying to make sense of it all?
I think the main thing is this paradox we've uncovered. You've got this seemingly strong equity rally on the surface, but it seems heavily propped up by expectations of pretty significant Fed rate cuts. And lurking underneath are these real, potentially underestimated risks around inflation. The whole thing feels like it's built on a rather delicate balance right now. Valuations seem dependent on a very specific, maybe optimistic outlook for prices and growth.
That's a really clear summary. So for you, our listener, the key takeaway is probably understanding that delicate balance. Don't just look at the headline equity gains. Realize that the underlying data, especially on inflation watch, is crucial. Keeping an eye on inflation reports and how the Fed reacts, that gives you the context to see beyond the immediate narratives and maybe anticipate shifts. Okay, so let's leave you with a final provocative thought to chew on this week. What if? What if the market's pricing of over 100 basis points of Fed cuts just doesn't happen? Maybe inflation stays stubbornly high, or the economy holds up better than expected, and the Fed simply can't cut that much. How might that scenario, fewer rate cuts than baked in, change how investors feel? How might it impact the economic outlook? Could it force a major rethink of the optimism we're seeing in markets today? Definitely something to keep in the back of your mind.